Hello everyone, thanks for joining. I'm Tyson Romanick, Senior Portfolio Manager here at Baker Boyer. And in this month's update, as you may expect, we're going to be addressing the new tariffs that were just implemented. So just last week, President Trump signed in a new round of tariffs before the August 1st deadline. And kind of at a high level, what he's done is he's increased kind of across the board tariffs from what they were, specifically for those countries where the U.S. has a trade deficit. Those are broadly going to go from 10 to 15%. And then on top of that, there's some specific countries that got singled out, like Canada and Switzerland, that got bumped up to 35 and 40%. So the big question is, how have tariffs impacted the economy and markets? So taking a look first at markets, before this latest round, markets had largely shrugged off the tariff news and the tariff impacts. So, just before all this came out, the U.S. markets had gotten to, recent all-time highs, same with international markets. So they had handled it pretty well. As far as the economy goes, GDP, there was a lot of noise with imports and exports quarter to quarter, but, if you average them out, GDP was still positive. It had just slowed a little bit. But to really understand the impact, we need to take a step back and look at exactly what is a tariff. And a tariff, simply put, is just a tax on imported goods paid to the U.S. government. Technically, the importer, the company bringing the goods into the country, pays the tax. But the more important question is who bears the cost? And there is a cost. So to see this, before all these tariffs came around, the U.S. was getting about $7 billion a month in tariff revenue. That's now gone up to $30 billion a month. And with these new tariffs coming in place, that most likely will rise even higher. There's only, three places those tariff costs can land. There's, the foreign importers, or I guess foreign exporters, which are the intended target. There's the importing companies and the U.S. consumers. So we'll kind of take a look at those three and see currently, where the cost is landing. So first, we'll look at the foreign companies that are exporting goods to the U.S. And if you take a look at this graph, you can see import prices. And if these foreign companies were bearing the cost, you would actually see a dip in the price. And all these prices are before tariffs. And what you're seeing is they've remained relatively flat. So these foreign companies aren't bearing the costs. They're just tacking the costs on top of what they're already charging the U.S. importers. Second, our consumers. Are they bearing most of the costs? Well, a good way to look at that is looking at inflation, a cost of goods and services. And if you look at the most recent print of inflation, it's gone up a little bit, but it's gone up from 2.4 to 2.7%. So it doesn't look like consumers are actually bearing these costs quite yet. So that leaves the third one, the U.S. importers. Think retail companies like furniture, companies or auto parts, dealers, and they're the ones that seem to be absorbing the costs. So one way we can see this is just looking at earnings, and companies' earnings have been positive, but they've been slowing down a little bit. So I don't think they've really seen the full impact either. In the first quarter, we saw a massive import before the tariffs took place of goods, by these manufacturers. And so that kind of carried them through the second quarter, which are the earnings that we're seeing right now. And so most likely that buffer of inventory is about to run out, and the third quarter is actually where we're going to start seeing it. And that is if these companies continue to bear the costs. And that's kind of the key is, each entity is going to be trying to pass off these tariff costs to another, whether it's the suppliers, the importers, or the consumers. And this cost shifting game is really why the Fed is thinking that inflation could continue to rise to, they're expecting maybe above 3% by the end of the year. But you also have to remember every company is different, every industry is different, and these shifts change over time. But this uncertainty maybe one reason why the Fed has been so reluctant to decrease rates. Even though they're showing signs that the economy is slowing, even though they might not actually come out and say that. So the hard part for the Fed is, these are unprecedented tariffs, and so they don't have a framework of knowing how long these will take to ripple through the economy and markets. So as usual, we will continue to monitor this very closely, and if you have any questions on tariffs or how this could affect your portfolio, please reach out to your Baker Boyer representative.